Greetings to everyone. My name is Edward, and you can call me Ed for short. You're all welcome to Pros and Cons Accountancy Tutorials. Today, we want to focus on IFRS 16, which is lease accounting. So the question is, what do we mean by lease? So when we talk about lease simply is a contract, right? To be a contract between two parties which actually gives the right of use of a particular asset. Let me say the right of use of an underlying asset to one party, right, in exchange for consideration. So you'll be given the right to use an underlying asset for a considerable period of time whilst you pay a consideration or you pay some intervals amount. Okay, then who are these two parties? One of these parties is the lessor and the other is the lessee. So the question you ask yourself is then who is the lessee and then who is the lessor? The lessor possibly, or let me say the lessor is the person who is providing the right. Who is providing the right. So the person who is giving the asset out is giving the right to someone to use the asset. Then who is the lessee? So the other way around is that the lessee is the one who is taking what? The right. So the lessor will be given the right, whilst the lessee will be obtaining the right to what? To use that underlying asset. All right. So then it means the assets in connection here, we call it the right of use asset. So that right becomes an asset. The right given to you becomes what? An asset. So in that case, we call something a right of use asset. A right of use asset. We will come back to right of use asset, but let us understand the overall concept of what? Of lease account. As I explained earlier, IFRS 16 says that lease is what? It's a contract, right? That gives the right to use an underlying asset for a particular period of time by giving what? Some consideration, by giving out some consideration, or let's say in exchange for consideration. We've already talked about who a lessee is and who what a lessor is. In actual fact, IFRS 16 has two types of lease. Two types of lease. One of this is operating lease, and the other is a finance lease. Operating lease and a finance lease. So the question we are going to ask ourselves is, then what is an operating lease? So the operating lease is the normal thing that we have been doing. So when we talk about an operating lease, what I'm going to do is that I give my phone or my asset for you to use, but this time around, I have right over the asset. The issue is I have not given the asset to you that it belongs to you. No, the asset still belongs to me though, but I've given you some right to use the asset and be paying me, let's say, every year. So if I give my car to you to use and pay me what? Let's say 1,000 every year. That is what? An operating lease. But there's going to be a distinction. There's a distinction between an operating lease and a finance lease. Because what I just mentioned can also be what? A finance lease. But there's some particular description, what we will talk about for you to know the difference between what the operating lease and a finance lease. Because if I give out my car for which you will be paying, for which you are supposed to pay 1,000 every year, it can be an operating lease or it can be what? A finance lease. So what differentiates these two? What differentiates these two? So Let's go to our board and look at something. One, we've talked about the definition of a lease or the definition of lease, right? Then we've also talked about the leasee and the leaseor, the leasee and the leaseor. Then we also mentioned right of use of what? Asset, right of use asset. But as I said, in dealing with finance lease, we will come back to the right of use asset again. Right. So we said the two types of lease. The two types of lease arrangement, we have the operating lease and the finance lease. The operating and what? Finance. And we are saying that it is just the giving out of an asset, right? Giving out the right for somebody to use an asset. It can be for operating, it can be for finance. So we have to find out what actually differentiates operating from what? Finance. Frankly speaking, when we talk about the difference is actually going to be on what? Finance. Because we know lease to be, okay, I've given you my asset, be paying me something, right? Every day, every year, be paying me something. Now, when we talk about the operating lease, with an operating lease, the person, the leasee does not what control the asset. The leasee does not have control over the assets. But for finance lease, at the end of the lease term, the leasee, or even whilst the lease is going on, the leasee has control over what? The asset. Now, if I have a control over the asset, then it simply means that whatever depreciation that comes from the asset, I have to recognize that depreciation because I have control. So it's more or less my own. So I have to recognize that depreciation in my financial statements. However, operating lease, hey, the lessor still control the asset. So it is not for the lessee, and the lessee cannot recognize both the asset and the depreciation in his or her book. In his or her book. But when we come to finance lease, then the lessee has the right to recognize both the assets and what? And the depreciation in his or her book. Now let's find out some of the issues under a finance lease. So for we to say a certain lease is a finance lease, then there should be some what? There should be some points which would differentiate it from operating lease. So if we say a finance lease, then it simply means that the lessee is going to use the asset for more than 75% of its useful life, right? So considerable amount of time, which is about 75% of the useful life. So here we are saying lessee uses the asset for more than 75% of the useful life of the useful life. You use the asset for more than 75% of the useful life. In that case, we can say that you are dealing with what? You are dealing with a finance lease. Now, the asset is also transferred to the lessee at the end of the lease term. The asset must be transferred to the lessee at the end of the lease term. At the end of the lease term, the lessee should be the one having what? The asset, the one controlling the asset. Right. So this will be we will incorporate this at the beginning of the lease contract. So at the beginning of the lease contract, it will state that, hey, once the lease term is done, the asset will be transferred to what? The lessee. In that case, we say then that contract is a finance lease what? Contract. All right. What other point can we talk about? So the other point is that the payment that the lessee is also making contributes what a substantial part of the cost of what the asset. It contributes what? It contributes to a substantial part of the cost of the assets. So the payments by lessee contributes to a substantial part of the cost of the asset. So you contribute a substantial part, or you pay out a substantial part of the cost of the asset. That's one point. Let's try and let's add one last point, right? So the other last point which differentiates operating lease from a finance lease is that only the lessee. So what I wanted to know is that this asset, more or less, is a specialized asset, and only the lessee can use what the asset. So at the end of the lease term, if we should transfer this asset back to the lessor is not going to use it for anything, right? It is a specialized asset which has been leased to you. And at the end of the day, nobody can use it again if you decide not to use it. So if you transfer it back to the lessor, what is the lessor using it for? So we say then it is you alone who can use it. So it becomes what? Your asset, and you have control over that what? Asset. So where we are saying where only the lessee, okay, let's say the asset is a specialized or is a special one, and only the lessee can use such assets. Then we also treat it as what? A finance lease. In that case, then we are going to treat it as a finance lease. Okay. So now, how then are we going to recognize the payments that the lessee is going to make to the lessor? So from what we've seen right now, if you have a lease agreement which has all these things, then it tells you that the lease agreement is a finance lease, but not what? An operating lease. So in an operating lease, you are not going to see all these things. You are not even going to see one of these things. It makes it what? An operating lease. Okay. How then are we going to recognize the amounts or the payment that we are making in our financial statement in terms of what? Operating lease, and then in terms of what? A finance lease. Now, in an operating lease, the only thing we are doing is I've given you my asset, you use it, then you pay me, right? So every year give me 1,000. That's it. So that payment will go into our P&L because we are dealing with a lessor and a lessee. So me being the lessee, if I give you that 1,000, I treat it like what? Lease payment. So it is an expense that I'm making, lease expense. So that lease expense will go into what? My income statement. It will go into my income statement. Remember, this is an agreement, or it's a lease agreement. So we will have a lessee and a lessor. One will treat it one way, whilst the other will treat it what? The other way. So the lessee treats it as what? As an expense, whilst the lessor treats it as what? As an income. So under operating lease, recognition. They are saying that under operating lease, we have the lessee, and then we also have the lessor. So whilst the lessee is treating the payments as lease expense, the leaseor is written as what? Lease income. The leaseor will be treating it as what? Lease income. Let's go to our next board and see how are we then going to recognize the assets. So recognition of the asset in question. So in recognition of the assets under operating lease, we are saying that the asset does not belong to what? The lessee. Because at the end of the day, it does not meet all the conditions that we wrote here under the finance lease. So the lessee does not have any control over the asset. So here, everything lies on what? The lessor. So the lessor will recognize what? The asset in their financial statement, right? Recognize the asset in its financial statement and also recognize depreciation on the asset in its what? Financial statement. But the lessee is not going to recognize anything in terms of asset. The lessee is not going to recognize anything in terms of what? Asset. Now, what about a finance lease? Recognition under finance lease. Recognition under finance lease. So the recognition under finance lease, how are they going to recognize the payments? How are they going to recognize the payments? So the payment is going to be recognized both by what the lessor and the lessee, like we can see in what the um um under the operating lease. But under the finance lease, same way, also under the finance lease is same way, the lessor is also going to recognize the payment, while the lessee is also going to recognize what? The payment. But what happens is that yes, it is payments that I'm making to someone who has leased his or her asset what? To me, right? So I will recognize that payment as if it's a liability. I will recognize that payment as if it's a liability. Remember, lease is talking about a contract. So the contract might be 10 years, might be 5 years, might be 2 years, might be 4 years, and the rest. So what I'm going to do is all the payments that I need to make, I will bring it to the present and it becomes what? A liability because it's something you've not paid. So it's a liability for you to pay. But we want to see it in today's terms. How much is it going to be in today's terms? That's why we call it what? A liability. That's why we call it a liability. So under finance lease, we have what we call the lease liability. The lease liability. So the payments becomes what? The present value of the payments becomes what? A lease liability. So the lease liability is equal to the present value of the future lease payments. That's what we call the lease liability. So let's say I've entered into a contract today and I'm supposed to pay 10,000 every December for 4 years. So if 1,000 for every December for 4 years, then it means year one will be 1,000, year two will also be 1,000, year three will be another 1,000, and then year four will be another what? 1,000. So the present value of all this becomes what? The present value of all this becomes my lease liability. Remember, if we talk about present value, then it means that we should have a factor to discount these thousand to the present. These thousand, we have to discount it to the present. When we are dealing with lease, one thing we always have to have get in mind is a payment that we make in advance and a payment that we make in arrears. In arrears. When we say you make a payment in advance, then it simply means that you make that payment, let's say, even before you start the year. You make that payment even before you start the year. Remember, in giving out this thousand, I made mention that it will be paid in December, meaning we will pay it in what? In arrears, ending of the year. So it makes this one goes for what? 1 year. So if we are bringing this to the present, we bring it to the present for what? We see it in what? 1st January terms. We want to see it in what? 1st January what? Terms. 1st January what? Terms. But when we say it is paid in advance, then it means that we have already paid it in 1st January. So we need not to bring this to the present. We need not to bring this to the present. That is what we need to put in mind. So a question may be given to you where they will say that, okay, the payment is being made, they make the payment in advance or they make the payment in arrears. Then you have to be careful with the first payment. If it is in advance, then it means the first payment will be made the very first day. The very first day. So we need not to bring the payment to what? To the present. You need not to bring it to what? To the present. So let's always be careful with that. All right. Okay. So we now understand when we say advance payments and arrears payments. Now, the question you ask yourself is, why are we bringing all this thousand to the present? It will be difficult because of time value of money. We want to know our liability today, right? 1,000 today is not the same as 1,000 in 4 years' time. It's not the same as 1,000 in 2 years' time. Even 1,000 today is not the same as 1,000 in 1 month time. So if we want to know the actual amount based on what? Time value of money, then we have to what? Bring it to the present. You have to bring it to the present. So if let's say our our implicit rate or the discounting factor is 10%, then it means that here it's going to be what? 10%. Our discounting factor is going to be 10%. Our discounting factor is going to be 10%. This is the amount. So our discounting factor is going to be 10%. Then we bring this to the present. So in bringing something to the present or having 10% to as our discounting factor is going to be 1 over 1 plus r raised to the power of what? N. N is the period, r is what? The rate. The rate is 10%. So here we will get 1 over 1 plus 0.1 raised to the power of what? N. And this N will represent period 1, period 2, period 3, period 4. So period 1 is going to be just what? 1. Period 2, you will just raise it to the power of what? 2. That is how it's going to be. So let me use my calculator. 1 divided by 1.1 raised to the power 1 will give me 0.909. So 0.909 raised to the power 2, 1 divided by 1.1 raised to the power 2 will give me 0.826, 0.826. Then raised to the power 3 will then give me 0.751, whilst raised to the power 4 will also give me 0.683. 0.683. Now, because the values we are paying is the same, yes, somebody can decide to use the annuity formula. Someone may decide to use the annuity formula. But, This is financial reporting. You are looking at ticks, right? So it's better you go with if you have time, then it's better you go with it like this and then get your rates, right? So what is then going to be our lease liability? 10,000 times 0.909, which is going to give us 909. So this is the present value. This is the present value. And then 1,000 times 0.826, which will give us 826. And then 1,000 times 751, giving 0.751, giving us 751. And then we have 683. So what will be the present value? 909 plus 826 plus 751 plus 683. That gives us 3169. So this is our present value. And that becomes the lease liability. That becomes the lease liability. So basically, when we talk about the lease liability, and when we talk about the recognition of the payments, this is how the lessee is going to what? Recognize the lease liability or the payment. So the lessee is only going to bring back all the what? Future payments to the present. What you have already paid has already been paid. It has already been paid. So that one, let's leave that one aside, right? But what is left to be paid, that is the liability. What is left to be paid is what? The liability. All right. So if the lessee is recognizing this payment as lease liability, how is the lessor going to recognize it? The lessor is also going to recognize it in their financial statements, right? As a lease investment or as a finance investment. As a finance what investment? Because in this case, he has something with you. So it has to be what? An asset for them. Your liability, which is a cost you think is a cost for you, is an income to them. So they will recognize it as what? As an income or a finance what? Investment or a lease investment that they have in their financial statement. This time around, you are also the one who has what? The asset. You have what? The asset, right? You have the asset. So you take it. But you are controlling it. So all depreciation is with you. You recognize the depreciation and also recognize what? The carrying amount of it. The carrying amount of it. Now, how then are we going to calculate for the right of use, the asset given to you? What is the cost of the asset? Because you have recognized the asset. If we say you should recognize the asset in your financial statement and also the depreciation in your financial statement, the question is, what is the cost of that asset? What is the cost of that asset? So that asset is what we call right of use asset. Right of use asset. Right of use asset. The right of use asset. So in your financial statement, if you see right of use asset, it simply tells you that there was what? There was a certain what? Lease agreement which led to this right of use asset. We may have even finished the lease term, but in your financial statement, you will see what? Right of use asset. It means this asset came as a result of what? A lease liability, or it came as a result of what? A lease contract. A lease contract. Okay. So what then becomes the right of use asset? We want to find the total cost of the asset that you are leasing. Okay. So the total cost of the asset that you are leasing, remember the 1,000 for 4 years is amount you are paying. So then it means that this liability should be part of the cost of the asset because you are going to pay this throughout. And if I'm giving you an asset, that I said, take the asset, it is for you, but you have to pay me 1,000 for 10 years. Then if we add all together, that becomes what? The cost of the asset, isn't it? So in that case, the first thing that we think about is the lease liability. So the cost of the asset, we are first going to get what we call the lease liability. we are first going to get the lease liability. So remember, we said this payment, you may have made some deposit. You may have made what? Some non-refundable deposits already before even coming to what? This 1,000 that you are paying for 4 years. And if this deposit that you made is in line with what the lease, then it means it is also part of the cost you are incurring to take control of the asset. So every or all non-refundable deposit that you've already made should also be part of what? The lease asset or the right of use what? Asset. So non-refundable deposits. Non-refundable deposits. Non-refundable what? Deposits. There are times too you may make some direct expenses based on the asset that you are leasing. Direct expenses like an amount to go and take the asset to it present the condition take the asset from, let's say, the lessor to the lease's place to come and install. You may have some installation amount. You may have some regulatory amounts to pay, some legal fees and those kind of things. Then some taxes and whatever you need to pay in line with what the lease that you are leasing, in line with the asset you are leasing. Then we say what? It is also part of the cost of the what? The right of use asset. So some direct payments, or let me say direct expense, direct expense. What are that? There are sometimes to the lessor will say, okay, I'll give you part of, I'll pay some of the things for you. So let's say this direct expense, the lessor decide, okay, he'll pay some of what the expense for you. Then it means there's a certain refund that you are getting from what this direct expenses. So refund from what lessor, refund from lessor. So the question you ask yourself, this is a refund, so you have to subtract it. You have to what? You have to subtract the refund. You have to subtract the refund. Well, in total, we come and get what we call the right of use asset, the cost of the right of use asset. Let's come here and then put it in perspective. So one, we said the right of use asset, the cost of the right of use asset. One, we are getting our lease liability, which we've already calculated to be what? The present value of all the future payments. Two, we are talking about non-refundable what? Refundable deposits. Non-refundable deposits that we've made already. So you may go and lease an asset and they will tell you that, okay, do a down payment. So that down payment is what? A deposit that you've made, a non-refundable deposit you've made. Okay. We also talk about direct expense. And this direct expense should be in relation to what? The asset you are leasing or the lease contract. And also we say refund from lessor. Right? So this one has to be taken out. Then at the end of the day, we will get the right of use asset. The right of use asset. So if you can see, we have the cost of the right of use asset or the current amount of the right of use asset, and we also have what? The lease liability. We also have the lease liability. So the lessor, the lessee, in this case, because it's a finance lease, was first recognized what? A lease liability, and also recognized what? The right of use asset. But subsequently, how is it going to be? The subsequent recognition. because this, what we've just done is just the initial. It's just the initial what? Recognition. So the subsequent recognition is that this is an asset. So you have to depreciate what? The right of use asset. Depreciate the right of use asset. And we say you amortize the liability. We will come to amortization later. Amortizing what? A liability. We'll come to it later. But in depreciating the asset, we say you depreciate the asset using what? The lower of the useful life of the asset and what? The lease term. So lower of lease term and useful life of assets. Useful life of the asset given to you. The lower of the lease term and the useful life of the asset given to you. So if the contract of the lease contract is given 8 years and the useful life of the asset is, let's say, 10 years, then we are going to use what? 8 years in depreciating the right of use asset. Depreciating the right of use asset. This is just to explain the operating lease and what? A finance lease, the concept of operating lease and a finance lease, right? Now, there are also some exceptions. There are also some exceptions. You may enter into a lease contract, and that lease contract is based on what? Is based on an exceptions of a exception that you would want to what an organization would want to use. So IFRS 16 adds some exceptions. It's not like we are not going to recognize it, but we recognize it based on what? Saying that it is a short-term lease or a low-value what lease. A short-term lease or it is based on what? A low-value asset. So one other thing is where we go through a short-term lease or a low-value asset. That is an exception. So an organization will decide to not go through either an operating lease or a finance lease, but rather use what? Short-term lease and what? A low-value lease. Now let's talk about a short-term lease and a low-value lease. But before we go on to talk about a short-term lease and a low-value lease, let's make a finance lease very what? Simple. Let's try to make a finance lease very what? Simple. So let's go to this board and then deal with a finance lease. Let's make it simple. So when we talk about a finance lease, all what we said is that one, let's find the present value of all what? Future payments. One is the lease liability, which is present value of all future payments. Present value of all future payment. Then two is the right of use asset. So the right of use asset, we made mention that it starts with what? The lease liability. So lease liability, non-refundable deposit, lease liability, the non-refundable deposit, direct expense, and then refund from lessor, sorry. Then we get a right of use asset. Then third, which is the subsequent recognition. This is a subsequent recognition. We are saying that one, depreciate the right of use asset. And here you are going to use what? Lower of lease term and useful life of the asset. So the asset in question, the useful life of it is what we are talking about. Then you can amortize the liability. You can amortize the liability. Remember, we said for the operating lease, it's just that one is recognizing it as what income, whilst the other is recognizing it as what as a liability. One is recognizing it as what income, whilst the other is so lease payment income, whilst one is saying lease what expense. The leasee is having the expense, while the lessor is having what the income. Okay, now then let's deal with the short term and the low value, the exceptions. Exceptions. If we choose to go by the exceptions, we are saying it is either a short term or low value asset. A short-term lease or low value asset. What is a short-term lease? Short-term lease is a lease for which the term is less than what 1 year, or the term is just 1 year. The term is just 12 months. That's all. The term of the lease is just what? 12 months. So short-term lease is within what? 1 year. So short-term lease is a lease contract within 1 year, or let's say 12 months. A lease contract within 12 months. So if I should lease something out, if I should lease something out to someone within just 2 months, then you say what? It's a short-term lease. Then what about low value? Low value. So unfortunately, the IFRS 16 actually didn't give a particular value to a low value lease contract, right? But it gives some asset for which it treats it under what? Under a low value asset. Now, the value we are talking about is not a value as at the end of the useful life of the asset. No, we are talking about a value at the beginning of what the asset. So we determine that value at the start of the asset, like at the start of the useful life of the asset, not at the end of the useful life of the asset. That's where we are going to determine what the value. So if it is this my phone that I'm giving out, right? If it is this my phone that I'm giving out, I'm going to determine the value, the low value I'm talking about. I'm going to determine the value as at the time they manufactured this phone. As at the time what they manufactured was this phone. That value is what I'm going to use as the low value. As the low value. But what are those items that was demonstrated to be what? A low value asset. And therefore we can treat it as what? A low value lease under a low value lease contract. Now let's look at those assets. One is tablets, right? It talks about tablets. Two is about small personal computers. Small personal computers. Small personal computers. Your MacBook and those kind of things. Small personal computers. Then telephones. 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 Then IV is small items of furnitures. Small items of what? Furnitures. These are the items under what? Low value lease contract. So these are exceptions. An organization can bypass and use what the exceptions rather than using operating lease or a finance lease. But the good thing is operating lease, the exceptions is not that different from an operating lease. The exceptions is basically not that different from an operating lease because when we talk about the exceptions, for example, short term, whatever I pay within that short term, if let's say I pay 9,000 within 9 months, I just take it to my P&L. Then the lessor will treat it as what? As an income. So that one too, you do not control the asset. That's what should come in mind. You do not what control the asset. It's just within 1 year. I use the asset within 1 year. Take your asset, take your money. Let me also recognize it in my income statement or P&L. That's all. What about the low value? So for the low value, the whole idea is that when we talk about low value, the question, if there's a question, then these assets, one of these assets has to be there. Whether it's a tablet, whether it's a small personal computer, whether it's a telephone or what, it's a small items of what, furniture. So somebody will say, oh, but we may buy about 10,000 tablets together. No. Yes, we may buy 10,000 tablets together, but we are talking about the value of each one. The value of what? Each. We still see it as what? A low value. So the total together can still be treated as what? A low value asset. A low value asset. Basically, today is to talk about lease, overview of lease. Then, God willing, in our subsequent videos, we'll be solving some questions to deal with what? Both these exceptionals and then the finance lease. If possible, we get a question also on what? On an operating lease. But once we are done with the exceptions, surely short-term lease is not different from what when we talk about an operating lease because it is just through your P&L and then the other will recognize also through the lessor also recognized through P&L, right? The last thing on lease is sale and leaseback. Sale and leaseback. So when we talk about sale and leaseback, I lease an asset to you. I lease an asset to you. Let's say I sell an asset to you. Sorry, I sell an asset to you. Then I come back to lease it. I come back what? To lease it. For us to say that a lease is a sale and lease back, then that first sale should meet the condition of IFRS 15. And IFRS 15 is revenue from contract with what? Customers. But hey, I don't want us to go much into sale and lease back today. So we will end our session here for today. As a summarize, let's go back and see what we've done for the day. So that God willing, in our subsequent videos, we can solve some questions to clear our mind on leasing and see how we will deal with what? The sale and lease back. All right. So today, our focus was on IFRS 16, which is lease accounting. We've talked about what lease actually means, and we said lease is a contract that gives the right of use of an underlying asset to a leasee, right? Gives the right of use of an underlying asset to a leasee for an exchange of what? A consideration. So the leasee will be paying something to the lessor. We made mention that the leasee is the one obtaining the right, whilst the lessor is the one who's giving out what? The right. And we said the types of lease that we have or a lease contract that we may have is what? An operating lease and a finance lease. In recognition and the operating lease, we said just an asset given to you that you are paying what, or the use of an asset that you are paying, you are making what, some interval payment, but you do not control what, the asset. So in that case, you do not recognize the liability. You do not recognize any liability. neither do you recognize any asset or what a cost on the asset, which is the depreciation. You do not recognize any depreciation. So at the end of each year or the beginning of each year, you just pay your amount and that will be all. You recognize it as what? A lease payment or a lease expense, whilst the lessor also recognizes it as what? As an income in their P&L. In that case, it is the lessor who is going to depreciate the asset and recognize the asset in his or her financial statement. That is all under operating lease. Then we said what makes an operating lease different from a finance lease. Then we give some conditions that need to be present for us to say that a finance lease, for us to say that this lease is a finance lease. First, we said the lessee, it means the lessee is going to use the asset for more than 75% of what the useful life of the asset. Second, the asset must be transferred to the lessee at the end of what? The lease term. Right? So if the asset will be transferred to the lessee at the end of the lease term, then we say that this is a finance lease. Another thing is that we said the payment by lessee contributes to what? A substantial part of the cost of the asset. So the payments I'm going to make, it contributes to a substantial part of the cost of the asset. So let's say the asset is 10,000, but the lease amount I'm paying is 8,000. Wow, that's a substantial part of what? The cost of the asset. So in that case, we say it's a finance lease. The last thing we mentioned is that the asset is a special one and only the lessee can use such asset. So if only the lessee can use the asset, after the lease term, if you transfer it to the lessor, what is the lessor using it for? The lessor will not use it for anything. So now it becomes the asset for what? The lessee, and therefore it makes it a finance lease. In recognizing the payment, we said under operating lease, as I've already mentioned, the lease expense and the lease what? Income. The lease expense and the lease income. But if it is under a finance lease, if it's under a finance lease, then the lessor is going to recognize an asset. Sorry, in recognizing the asset under operating lease, yes, the lessor is going to recognize the asset in its what? Financial statement, and also the depreciation in its financial statement, something we've already mentioned. What about the recognition under finance lease? Under finance lease, we made mention that we call something what the lease liability, because here we are talking about the future payments you are going to make. So bring all the future payments together, it becomes what? The lease liability. It becomes the lease liability. So as a lessor or the lessee, you are going to recognize a lease liability. So that lease liability is what the lessor is also recognizing it as what? As it's not going to be receivable because it's a long-term something. So it's going to recognize it as more or less a finance what? Investment, or a lease investment, or let me say a finance what? Investment. So it is an asset that the lessor is going to recognize, whilst the lessee is recognizing what? A liability. Now, we said we have to understand when we say something is paid in advance and then in arrears. When we take a question dealing with what? Finance lease, we will have to know what we mean by in advance and what? In arrears. Because when we say in advance, then it means it is paid at the beginning of the year. So if you say in advance, then it means a certain amount has been paid at the beginning of what? At the beginning of the year. But when we say in arrears, then it simply means that it will be paid at the end of what? At the end of the year. So in bringing all the present values, all the future values to the present, and we say in advance, then it means the first payment had already been made. So there's no way we bring in that one what? To the present. It will not be part of the present what? Values. So let's be careful with this. I'm very particular about this because most students normally make mistakes here. Right? So we have to be very particular about that. But if it is paid in arrears, then it simply means that we've not done it. We've not done any payment. We've not made any payment. So everything, we can bring everything to the present. Then we get the lease liability. And we said it is the lessee who also recognizes the asset as well. And the name of this asset is a right of use asset. what will be the total amount of this right of use asset? The future payments that you are going to make that you brought to the present is part of the payments you are going to make. So that should be your first thing, which is the lease what? Liability. Then any deposit that I've already made, because sometimes you are going for a lease, they will tell you that, oh, make a down payment so that we get to know that, yes, you are ready, you are really serious about this. So any deposit that you've also made, which is non-refundable, if only it is non-refundable, then it is part of what? The right of use asset. Well, you may also incur some direct expenses because maybe you need to bring the asset from the lease's place to your place. You may incur some direct expenses like installation costs, some taxes, some regulatory costs, legal costs, and those kind of things. Then we say it is part of the cost of the asset. What if the lessor also decide to pay something to you, refund from the lessor? Then in that case, you are getting some differences for which you need to less out from the total amount. So you can see as we have the cost of the right of use asset. Then in subsequent recognition, all what you need to do is just depreciate the right of use asset and then amortize the liability. As I said, in our subsequent videos, we will take a question and we'll get to understand how the amortization of the liability is going to be. But for now, we will end it here for today so that in our subsequent videos, we will take some questions and deal with the rest of the issues. As I said, sale and leaseback will be dealt with separately, right? We will deal with sale and leaseback separately because it has some level of misunderstanding that students normally get. So we are going to take it separately and deal with it. Today, this is where we will call it a close. My name still remains Edward, and you can call me Ed. Here is pros and cons accountancy tutorials. Thank you very much for joining us and for watching this video. I'll say, please, 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 if our videos seems interested, or if you seems interested, please kindly subscribe to our page and like it for us. Subscribe and what? Like it. And you can share to all your family and friends, all those who need it. Right. This is financial reporting. This is IFRS system, and I believe everybody will need it. So you can share to each and everyone for us. Thank you very much. And I want to say we are very grateful for all the likes and also the sharing. All right, this is where we call it a close. Bye-bye.